Welcome to The Explainer. We hear a lot about keeping financial markets honest. Well, today we're going to pull back the curtain and look at the actual rules. We'll be digging into this big idea called market abuse and its most famous, or maybe infamous, cousin, insider dealing.
All right, let's just start with the big one, a question that really gets to the heart of it for, well, pretty much anyone with a pension, savings, any kind of investment. Is the game fair? Is the stock market actually a level playing field? For the whole system to even work, we all have to believe it isn't rigged, right? That feeling of trust, that's everything. It's the absolute bedrock of a healthy economy. And that trust? It's all built on a foundation of solid, clear rules.
Okay, so let's dig into that. Why do we even have all these regulations? What are they really trying to accomplish?
And the goals here are pretty straightforward when you look at them. It's all about building confidence, right? Making sure the economy can grow, protecting us, the consumers, and of course, making it a lot harder for criminals to exploit the system. You can see how each of these things kind of builds on the others to make a market that people actually want to be a part of. But that last one, reducing financial crime, man, that is a constant battle. Because what happens when someone decides to break that trust just for their own personal gain? Well, that's when we step into the territory of what's called market abuse.
So, market abuse, that's the big official term for all this bad behavior. Basically, it's any action that takes advantage of privileged information or tries to warp the market. And listen, this isn't just a threat to one or two investors, it can actually threaten the stability of the entire system. And market abuse isn't just one thing, it's got a few different flavors. Of course, there's insider dealing. We're going to get deep into that in a second. But you've also got stuff like manipulating transactions. Think of it like creating a bunch of fake buzz to mislead people. Or dissemination. That's just a fancy word for spreading false rumors to mess with a stock's price. At the end of the day, all of it just completely undermines the whole idea of a fair market. Okay, so let's zoom in on the one you've definitely heard of. The one that makes for great movies. Insider dealing. Really, it all boils down to one thing. Unfair advantage. An insider is using secret information, stuff the public doesn't know, to make a trade. It is literally like knowing who's going to win a race before the starting gun even fires. So, here's the classic example, right? A director at a company finds out that their profits are about to go through the roof. If they run out and buy a ton of shares before that news gets announced, well, they're cashing in on a secret nobody else has. That is the textbook definition of insider dealing. But for something to actually be the crime of insider dealing, it has to check three very specific boxes. So let's break down what those are. First up, you need the insider. And this is broader than you might think. It's not just a CEO or a director. It could be their lawyer, their accountant, anyone who gets access to that info because of their job. Heck, it can even be someone who just gets a tip from one of those people. The key here isn't just who you are, but how you got your hands on that information. Okay, second ingredient, the information. This can't just be some vague rumor you heard at the water cooler. It has to be specific, it has to be non-public, and, this is the big one, it has to be significant enough that it would probably move the stock price if it got out. That's the stuff we're talking about. And third, you need the securities. The illegal deal has to involve certain financial products. And we're not just talking about regular old company stock here. The rules cover a whole range of things: bonds, options, futures, basically anything whose price would be affected by that secret information. Okay, so we've got the what, right? We've broken down the offense. But why does this matter so much? Why is this such a huge deal? Why do regulators across the globe put so much effort into stopping it? Well, first off, you have to understand this is not a victimless crime. You've got the top global organization of securities regulators saying this stuff is a direct threat, not just to fairness, but to the stability of the whole financial system. Think about it. When people believe the game is rigged, they just stop playing. They pull their money out. And that hurts everybody. And that really brings us to the core of it, the big takeaway. All these rules, all this effort, it's all about one thing: fairness. It's about protecting every single investor, from the biggest hedge fund to the person with a small retirement account. Because when you maintain that trust, you build a stronger, more reliable economy that in the end works better for all of us. So that leaves us with a pretty big question to think about, right? Because technology, with AI and high-speed trading, information is moving faster than ever. So how does the fight for fair markets keep up?
How will the rules have to change to keep that playing field level when the game itself is getting faster and more complex every single day?